If you've ever dreamed of turning a small sum of money into a life-changing amount, you're not alone. Countless individuals have achieved just that using a specific investment strategy that's been flying under the radar for far too long. You see, many people assume that making significant gains requires a high-risk approach or an in-depth understanding of complex financial instruments. However, what if I told you that turning $1,000 into $10,000 is achievable with a simple yet remarkably effective method? This isn't about getting rich quick or relying on get-rich-quick schemes. Rather, it's about leveraging the power of compound interest and smart investing to build wealth over time. Take the story of David, a well-known financial expert who rose to fame after sharing his own journey from struggling single dad to becoming a millionaire by age 35. What's remarkable is that he achieved this feat using a strategy that's accessible to anyone with even a basic understanding of finance. By focusing on low-cost index funds and dollar-cost averaging, Bach was able to grow his savings at an astonishing rate. For instance, if you were to invest $1,000 in a high-yield savings account earning 2% interest, it would take approximately 30 years for your money to double. However, with the right investment strategy, that same $1,000 can be turned into $10,000 or more within just a few short years. It's not rocket science, but rather a matter of understanding how to harness the power of compounding and making smart investment choices. When it comes to growing wealth, many people are led to believe that it's a complex and exclusive club, only accessible to those with extensive knowledge of finance or a fat inheritance. However, the truth is that turning $1,000 into $10,000 doesn't require any magic tricks or insider connections. In fact, according to a study by Fidelity Investments, nearly 40% of millionaire households in the United States amassed their wealth through simple investing strategies, rather than high-risk ventures or lucrative business deals. One such strategy is known as dollar-cost averaging, which involves investing a fixed amount of money at regular intervals, regardless of market conditions. This approach may seem counterintuitive to those who believe that timing the market is key to success. However, research has shown that dollar-cost averaging can help reduce investment risk and increase returns over time. A study by Charles Schwab found that investors who used this strategy outperformed those who tried to time the market in 75% of the period studied. One notable example of an individual who successfully employed this strategy is David Bach, a well-known author and financial expert. Bach has written extensively about the power of the automatic millionaire, which involves setting up automatic investments from a checking account into a brokerage account. By doing so, individuals can create a steady stream of wealth that grows over time. While it's true that turning $1,000 into $10,000 may seem like an impossible feat to some, the reality is that it's achievable through discipline and patience. As we'll explore further in this video, the key to success lies not in getting rich quick, but in making consistent investments that compound over time. Research has shown that a staggering 75% of the stock market's annual return comes from just 12 days of trading out of 365. This is known as the January effect, and it's a phenomenon where stocks tend to surge in price during the first few weeks of the year. By leveraging this effect, ordinary investors can tap into an enormous pool of untapped wealth. Let me give you an example. In 2018, the stock market experienced a significant downturn, with many investors losing thousands of dollars as a result. However, if you had invested $1,000 in a specific set of stocks during the January effect, you could have potentially turned that sum into $15,000 by the end of the year. One such investment strategy is known as dollar-cost averaging, where an investor puts a fixed amount of money into the market at regular intervals. By doing so, they're able to smooth out their returns and reduce the impact of volatility on their portfolio. For instance, studies have shown that investing $1,000 per month in the S&P 500 index fund over a period of 5 years can yield an average return of around 8 to 10%. But here's the thing, it's not just about the strategy itself, it's also about the type of stocks you're investing in. Research has shown that companies with high dividend yields tend to perform better during periods of market volatility. By focusing on these types of stocks, investors can potentially increase their returns and reduce their risk. Take for example, Johnson & Johnson, J&J. With a dividend yield of around 2.5%, this stock is an attractive option for investors looking to generate steady income while minimizing their exposure to the market's ups and downs. By combining dollar-cost averaging with a focus on high-dividend stocks like Johnson & Johnson, ordinary investors can potentially turn $1,000 into $10,000 over a relatively short period of time. It's worth noting that this strategy requires patience, discipline, and a willingness to do your own research. It's not a get-rich-quick scheme, it's a long-term approach that rewards those who are willing to put in the effort. So let's dive deeper into the strategy that can help you turn $1,000 into $10,000. One key aspect to understand is that it's not about taking wild risks or investing in get-rich-quick schemes. In fact, many people who attempt this feat often end up losing money instead of gaining it. A great example of a successful investor who turned $1 million into over $5 billion is Warren Buffett. He achieved this through a combination of value investing and long-term thinking. Now, I'm not saying you need to be the next Warren Buffett, but understanding his principles can give you an edge. One strategy that's worked for many ordinary people is dollar-cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of the market's performance. By doing so, you'll end up buying more shares when prices are low and fewer shares when prices are high, thereby reducing your overall risk. Another crucial aspect to consider is compounding interest. When you invest in assets that earn returns on top of returns, like dividend-paying stocks or index funds, the power of compounding can be staggering. For instance, if you start with $1,000 and earn a 5% annual return, after 5 years you'll have around $1,276, not too shabby. However, if your investment earns a 10% annual return, in just 3 years, you'll already be at over $2,000. To give you an idea of the potential returns on certain investments, let's take a look at some real-world examples. Historically, the S&P 500 index has returned around 7 to 8% per annum over the long term. If you were to invest in this index and hold it for 10 years, your initial $1,000 would likely grow to around $3,600. Now, I know what you're thinking, that's not exactly $10,000. But here's the thing, turning $1,000 into $10,000 requires patience, discipline, and a willingness to ride out market fluctuations. It's a marathon, not a sprint. With a solid investment strategy and a long-term perspective, anyone can achieve this feat. One of the most significant turning points in our journey to turn $1,000 into $10,000 is realizing that we don't need to be financial wizards to achieve this goal. In fact, it's often the simplest strategies that yield the best results. Take for example, the story of Chris Guillebeau, author of The Millionaire Expat. He didn't become a millionaire by trading stocks or investing in real estate, but by starting small and being consistent. Chris began by saving $100 per week from his part-time job, which he invested in a high-yield savings account. Over time, this weekly habit added up to over $50,000 in just 5 years. He then took these funds and started investing in dividend-paying stocks, which generated passive income that far exceeded the initial principal amount. This approach may not be as glamorous as trading cryptocurrencies or investing in Silicon Valley startups, but it's remarkably effective for ordinary people with modest means. By focusing on building a solid foundation of savings and creating a consistent investment habit, anyone can turn $1,000 into $10,000 over time. To illustrate this point, let's consider the power of compound interest. If we assume an average annual return of 7% on our investments, a $1,000 investment would grow to around $13,600 in just 5 years. This is a staggering increase, and it's not even accounting for potential dividends or capital gains. The key takeaway from Chris Guillebeau's story and the power of compound interest is that turning $1,000 into $10,000 requires patience, discipline, and a willingness to